when you have this open market that is able to come in and start investing in these businesses, and these are investors that 85% on average are within a 5-mile geographic radius of the business they're investing in. One of the unique things that happens there is you're moving the market validation phase for this business into their fundraising phase, like far earlier in the process.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Eric Hornung, and I'm accompanied by my co-host, Mr. High Street himself, Jay Klaus. Jay, how are you, man?
I'm great. I actually have not come across vomit in front of my apartment door in some number of weeks, but that's probably due to spending a lot of time with friend of the podcast, Mallory, and not seeing my front door on the weekends as much.
Nonetheless, you do live on High Street, which is the primary strip of real estate in Columbus, Ohio, and you have quite the deal going on, don't you?
I do. I'm here in the thriving heart of the Short North, the Arts District here in Columbus, which has really been developing fast over the last several years. Constant cranes. If you listen to the podcast, you'll probably often hear some sort of industrial or construction noise, large trucks backing up. I have a turntable here with, what do you call these? Analog speakers?
Speakers.
I have a turntable of speakers here. And lately, because of the construction across the street from my apartment, there's been a bunch of flatbed trucks bringing in materials, and these speakers pick up the ham radios of those trucks. So I'm sitting here and I'm often just listening to truck driver audio in my speakers, and it's very weird and honestly never interesting.
What's the least interesting thing you've heard?
I can't even recall any of the things they've said because nothing has been worth remembering. It's always just like, all right, I'm going to take a left up here. I'm going to back up.
That's it? Is that like your truck driver voice?
It's basically just like directional, like, heads up, I'm about to do this thing, and never like, hey, did you watch the last episode of Twin Peaks? I just can't figure out what's going on with Special Agent Dale Cooper. I would love to tune into that conversation. So not only am I not tuning into the conversation, I'm just being given the conversation, and it's not that interesting. But here we are on High Street, which all of Columbus seems to be oriented around besides the suburbs. And I have a pretty good thing going on here.
Would you say that High Street is the main street in Columbus?
I would say that High Street is the main street of Columbus, yes.
Yeah, me too. It's always buzzing. There's just so much going on. Bars and restaurants and shops, and I always wonder how all that gets funded.
Well, maybe we'll have a little insight into that today, Eric, with our guest, Nick Mathews, the co-founder of Mainvest. Mainvest is building a new asset class of revenue-backed securities in the small business space, allowing brick-and-mortar small businesses to access capital through local investment. They are a regulation crowdfunding intermediary regulated by FINRA, focusing on the brick-and-mortar cash flow generating Main Street businesses from a diverse set of industries ranging from restaurants to breweries to hair salons and escape rooms.
In the finance industry, Jay, we call that FINRA.
In the finance industry, the Mainvest is Patagonia.
That was pretty good. I'll give you that one. That was pretty good.
Mainvest was founded in 2018. It's based in Salem, Massachusetts, and it's raised $3 million to date from Lair Hippo, Rucker Park Capital, and the Uber Alumni Syndicate. Eric, Nick Mathews, is an early employee at Uber, or was an early employee at Uber, which is also an interesting sidetrack that we'll try to keep from spending too much time on.
We probably will fail there. Uber Alumni Syndicate is going to be a very unique investor for this podcast.
We'd love to hear your feedback as we go through this interview, so you can tweet at us, as always, at UpsideFM, or email us hello@upside.fm as we go through. And we'll get into that interview with Nick right after this. Eric, let's pretend that you're going to take initiative and start a company. You following?
Never done that.
All right. Well, you helped start the Up company here, so a little concerned.
Just kidding, Jay. Of course, let's pretend. Let's go down your hypothetical path
And let's pretend that you are trying to find some of the most talented engineers to help you get that company started. How many engineers do you think you know?
Not enough.
Not enough. And that's why I would recommend you work with our friends over at Integrity Power Search. Integrity Power Search is the #1 full-stack, high-growth startup recruiting firm between the coasts. They partner with venture capitalists, private equity groups, and CEOs like you, Eric, to build amazing teams to the world's most disrupting companies. If I'm hiring, if I'm trying to find good engineers, I'm not going to rely on my small group of connections. I'm going to go to a group like Integrity Power Search, who has thousands and thousands of potential connections, potential hires for my company.
That sounds like enough to me.
Sounds like enough. Sounds like you're going to find the best talent when you can dip into a larger pool. They've executed more than 600 searches successfully, and they're on track for more than 200 in 2019 alone. Their clients have collectively raised over $2.5 billion with a B, Eric, in venture capital funding and counting. So if you guys want to learn more about Integrity Power Search, go to upside.fm/integrity to get started with their team. Nick, welcome to the show.
Hey, thanks for having us.
On Upside, we like to start with a background of the guest. So can you tell us about the history of Nick?
The history of Nick. Nick grew up north of Boston, Massachusetts. The majority of Nick's adult life was spent at a company called Uber. Really, my background, I was a poli-sci major at UMass Amherst. Ended up pretty much right out of college being out in San Francisco for a summer, experiencing this company in a unique way where I think it was at a bar on a Saturday night. It was like 2 a.m. and some guy that just looked like the kind of guy that was not like a nice person, strutted out of the bar and into a black car. And I was like, who's this guy? Why is he getting into this super fancy car? And I had learned about Uber kind of through that. And a week later, had some conversations and ended up going back to Boston, where I'm from, to launch Uber in Boston, and spent the next 6.5 years there. And then after that, left Uber really to start this with. That was kind of the plan. The history of Mainvest, I think, starts in 2013. And really when we were looking at suburban expansion for Uber outside of major metropolitan areas. And I was kind of leading the charge looking at Worcester's and Salem, Massachusetts, these different places, and trying to figure out, that this works in a densely consolidated metropolitan area, but what are the factors and how does it come to play, both on the supply side for driver acquisition, on the demand side for rider value, how much liquidity in a marketplace do you need to have that? But kind of in looking through that, really drove down a lot of what eventually became economic development rabbit holes, and looking at a Worcester or a Lowell, Massachusetts, areas that had kind of experienced this economic distress, and a lot of it around manufacturing being moved overseas. There's a lot of mill towns up here, and then also on the shipping and transportation side, Worcester used to be a hub for that. And, as it moved, because it was a train location, and as a lot of transportation moved from rail to rubber with trucking industry, all of these different things that affect that. And it was kind of there that I saw this massive challenge that just didn't seem to make sense around access to capital for small businesses. And looking at the kind of cycle of why it's different now than it was before, you had this, the traditional model for small business accessing capital is usually a term loan structuring through an institution, local community bank or Bank of America, depending on the size. And it's heavily collateralized against personal assets for a new company to go in and do it, or you have to have multiple years of revenue history. And what happened, it looked was in around 2010, there was a financial collapse, and the #1 collateralizable asset for these things was home equity. And as that asset became volatile, small business lending dried up. And then even though the housing market did eventually recover, and knock on wood on how things are going in general right now, the other thing that changed is the profile of a person that is starting this business. People are buying houses much later in their lives, and you can talk about student debt and all these different things that kind of lead to that. So it just created this unique kind of gap in this market that was limiting economic growth on a local level in these areas.
Hold on, let me go back a quick second first. Talking about the history of Nick here, and you see this angry looking guy get into a black car, and that's how you found Uber. Did you follow him into the car, and that turned out to be Travis Kalanick or something?
No. There was I think Travis and Ryan at Uber.com test emails that were sent that started those conversations.
Oh, wow.
Try to fast forward past the Uber part and kind of get to what we're doing now, but happy to dig into parts of the time there if interested.
Something you touched on that seems relevant. It sounds like, you said you were starting to look into some of these suburban areas, and that was part of your role at Uber. Can you talk just a little bit more about what your role at Uber looked like over the course of 6 years when it started? Sounds like pretty early on in the company's history.
For sure. Yeah. We started, it was to launch Boston. It was our fifth market. I was really on the demand side, communications to riders, rider acquisition. We scaled that team over the course of the next 3.5 years to, our Boston office in 2015 or 16 was 80 people or so. My team was 12 to 15 at different points, and really focused on, at that point we'd expanded from just downtown Boston to really all of New England. And at that point, I ended up moving down to DC, where our U.S. operational headquarters is, and moved into a U.S. and Canada business development role around entertainment venues, sports, that kind of space, where you had this unique challenge where Uber was designed very well for these kind of urban, suburban settings. But when you have a location that's really designed to bring a bunch of people there, have them stay there for 4-6 hours, and then leave, we kind of had to retrofit the app to fit that and work with a lot of these different groups around really taking an operational forward plan to allow for Uber to make sense and work there, reduce drunk driving. And through that operational plan, doing the operational solves to make it a reliable service, we were also able to kind of work with them on some of the marketing side stuff, working with the Patriots and Jacksonville Jaguars, a lot of the sports entertainment venues, where because we were able to kind of take this approach of coming in, solving a bunch of operational problems, we were able to kind of access the sponsorship and marketing aspect of it at a much lower cost, and in some cases at a negative cost, than if we had just gone from the start and signed a $8 million exclusivity deal with the New England Patriots.
Guy from Boston bringing up the Patriots. I think we're less than 5 minutes into the conversation here.
And it's funny because the one part of Boston culture that I always felt outlier from, I'm not a huge sports guy, and so it was very unique that I was in that situation and talking. We had met with the Crafts early on and talking about. I use that because I was from Boston. That was one of the first cases that ended up being probably replicated 40-60 times across the East Coast. But and I just felt very disingenuous trying to talk about it, be excited because I enjoy the sports with friends kind of thing, but I was never the numbers guy. I don't have a DraftKings account kind of thing.
So when you're launching the fifth Uber market, I imagine that's a very different experience than the people who launched the 150th Uber market. Who were you relying on? Were you talking to the other 5 markets about what was going right or wrong? How are you figuring this all out?
Yeah, we were definitely figuring it out in real time. And I would say for that first kind of 1.5 to 2 year period of Uber, the best relationships were the market relationships with your peers and colleagues. And it was a very collaboratively competitive environment, where everyone was kind of trying to figure out all of the different ways that we can kind of bring this to people, have them understand this really new thing. If you look at smartphone adoption back in 2011 compared to now, it actually smartphone adoption, that curve really was crossed the chasm in that phase. And so getting people to see the value of being able to click a button, get a ride on demand, it was unique to think about it at that point in time. It's almost hard to even think back to that when people just had no idea what we were. And working with all of the peers in these other cities, that was a really strong network that has been maintained to this day.
You've been part of what is potentially the highest growth startup in the last decade, and you were an early employee there. So I would imagine that you didn't have to go and start a company. What makes Nick tick that you decided, oh yeah, I'm going to go found a company?
It's funny to say because I kind of felt the other way around, where I have to go start a company. The idea around that experience and those learnings that really made up the majority of my adult life to this point, there was this sense of what is the actual value in that if you don't apply it to something. And I have the firm conviction for the majority of my time there, especially the earlier time there, we were a very mission-driven company. It was hugely inspiring. Without even thinking about it at the time, there was a massive economic development component, job creation, creating these new opportunities for people to, in their free time, increase their income using an asset that they already have and like is a fixed cost asset, was really inspiring. And on the rider side, it was just simply a better product than the products that currently existed. The implications around reducing traffic through carpooling, the idea of drunk driving dropping precipitously in cities when Uber came to those cities. Like there were some really, really good things we were doing. And we were also learning a lot to that point of being in one of the fastest growing private companies of all time. It was definitely a roller coaster. And again, it kind of gets back to developing those learnings. And as we were kind of going through that 2014 period when we were looking at the regional expansion, seeing that a lot of the economic development rabbit holes, that access to capital, like that was like, it led to this question of, well, why can't people just invest in businesses, right? And there was a stopping point upon further exploring that with these credit investor regulations, part of the Securities Act 1934. A lot of that actually, I think, tied into fraud around mineral rights. There's oil and gold in those hills, sign this thing. And they're like, we have to find a way to create a framework for investor protections. And they did that in 1934. And a lot's happened since 1934. So maybe they needed to be revised, but that was kind of a stopping point. And the idea was just percolating in the back of the head. And then when I had moved down to DC, it was right around December 2015. During that time there, was right when the regulation crowdfunding regs, Jobs Act Title III, was on the floor of the House and the Senate being commented on, and saw that, I guess to back up a little bit, the impetus for the Jobs Act was, I think Uber has a little bit to do with it, ironically, but looking at this massive amount of wealth generation that was coming out of Silicon Valley, limited to only accredited investors, and retail mom and pops didn't have access to that. And that combined with the fact that access to private capital, like private equity venture, was really, flowing over that. You can look at SoftBank, Saudi investment into US tech, and it allowed these companies to continue to capitalize on the private markets and elongate their cycle before a potential IPO, which then by the time they IPO'd, the majority of that early risk and upside was limited only to the accredited investors, which is around 7% of the population, but even more so with an Uber or an Airbnb, to the fractional percentage of people that actually had access to the deal flow for that. So, the heart of the regulations, really the spirit of them, was creating a regulatory framework to allow for non-accredited investors to begin to access these different asset classes, really focused on the early stage startup side. And so if you look in 2016 at all, the bylines, when it kind of first came out, it was always described as equity crowdfunding, but in reality, it's not. It's securities crowdfunding. And we can kind of get to why that's important in a little bit. But in kind of looking at the regulations, it was, wait a second, does this solve that problem on that side of the marketplace that would be able to create a framework to better allow small businesses to access capital? And that really was the ticking point for Mainvest to start being accepted.
Let's go into that a little bit deeper. Why is it important that it's different between equity crowdfunding and securities crowdfunding?
Well, so I think, really the regulations were designed around early stage startups and, high growth companies. That was kind of the impetus for them. And because of that, it was described as equity crowdfunding. But a small business, isn't going to raise an equity round. There are challenges with that. Small businesses aren't trying to become $100 billion institutions. There are people that are just starting great community businesses, the types of businesses that form the cornerstones of main streets and around the local economic development engine. Having a strong ecosystem of local amenities-based businesses is one of the first steps to driving, larger company investment into an area, making it a livable place that people are enjoying and want to go to. And really that sense of community is important, but they're not going to raise a priced equity round. They're not going to IPO. They're not going to get acquired in most cases. They're looking to generate capital as a cash flow business, make money, provide jobs to local people in the community. And I think that was kind of people didn't seem to be seeing it for that, but the fact that it allowed that was kind of the gateway to figuring out a way to build this product.
So help me kind of close the loop on timeline here. You said you started to see some of these community development rabbit holes in 2013. You moved to DC in 2015. The Jobs Act is starting. When did you finally put your chips down and say Mainvest is going to happen? And why did that moment happen?
So I knew Mainvest was going to happen from middle to end of 2016. I left Uber in February of 2018. That period in between was, that still working for Uber, trying to do the best I could as a company grew from, 30, 40 people when I joined to around 20,000 people in like 2017. It was kind of a different world. So it was really, in a way, unpacking and separating from Uber and realizing that this was what we wanted to do. It was at that time I had reached out to a college friend, Ben, who ended up becoming one of my co-founders as the CFO. He had a finance track. After college, he had gone to a boutique valuation firm that was doing small business valuations, and then ended up at Grant Thornton, which is a accounting firm, but leading a valuations team for complex debt and equity. It was super relevant, very, very coincidental. Talk about like a great synergy. And so when I had initially talked to him, it was like I hit a stopping point on my knowledge of the financial space, and I needed someone that I trusted that was an expert. And so it was really just, I remember the first time like grabbed lunch and I just had like a legal pad and I just made him not stop talking for like 2 hours, and he missed a meeting. I felt bad about that in hindsight, but just better understanding the space. And then over kind of the next year of talking through it, I think I kind of incepted it in him, and he was like, we got to do this. Yeah. February 2018, I left Uber. I think he left Grant Thornton in April of 2018. We worked with our other co-founder, Felix, who I had met down in DC, built out the MVP. It was a unique situation where you think about being able to like beta test is a core part of like an early stage startup, but you can't really beta test selling securities in a heavily regulated environment. So in order to get the approvals, you had to build out a fully regulatory compliant product, which we, with our co-founder, CTO Felix, did from basically March to June of 2018. We started the FINRA approval process in June. We were approved October 15th, and we launched October 27th.
So in your words today, what is Mainvest?
So Mainvest is an investment marketplace for communities to invest in local businesses in those communities, and for small businesses to be able to raise capital that really works for them by raising it from people that are actually going to be consumers of that business, able to participate and act as like evangelists for that business, to allow it like small businesses in that crucial first year that is usually the most challenging year to have something they've never had before, which is true aligned buy-in from their local community.
I think people throw around the term small business a lot, but can you help give us a little bit more definition around what that is on the Mainvest platform and what you're seeing? Like what percent is restaurants, what percent is services, what percent is just kind of a little bit more insight there?
So I think the way we think about small business is really with a community mindset, and in this sense of brick and mortar, business to consumer, providing like services in the sense of, not like an accounting firm, right? But more as like restaurants, breweries, yoga studios, hair salons, the types of like amenity-based businesses that do form that cornerstone of like a Main Street community.
So can you give me a very like tactical example? You launched last year in October. What is a business that has used the Mainvest platform, and what has that case study evolved into?
Obviously, a few different examples we could use, but one of our first businesses that I was super excited about was a business called The Plan, which is a hair salon opened this June in Holyoke, Massachusetts. Holyoke is what's called it's one of the 26 gateway cities, and in fitting that kind of form a narrative around cities that had, kind of the economic distress cycle from a mix of like manufacturing challenges over the last like 30, 50 years and are kind of in this economic upturn. The plan was two female co-founder entrepreneurs that were able to raise the $80,000 they needed to launch their hair salon. They had been stylists working with other hair salons for I think 7 or 8 years each. They had experience, they had a great local following, but they weren't able to raise from like traditional institutional finance because it was a new business. They didn't have a house to collateralize. They didn't fit the model, but outside of the model, it was just a great community business that we were able to empower. And since they raised, they did exactly what they said they were going to do, and have launched this beautiful hair salon in downtown Holyoke. mayor was at the ribbon cutting ceremony, being kind of used as a case study for the revitalization of Holyoke. And that was a super exciting example of like when they got successfully funded, we were one of the first businesses that did, like we knew this was going to work.
So these investments aren't collateralized, or how do these investments work from a securities perspective? They're not equity, they're not collateralized debt.
They're debt.
They are debt.
They would be classified as debt. And, we, in designing this, and this is where honestly, I think Ben, like me talking about like the design, I was like a disservice to Ben, who was so instrumental in this process and True couldn't have done it without him. In looking at how to structure an investment that made sense, when you think about like complex debt and equity investments, it's all about like finding ways to align incentives. And a traditional term loan coming from one financial institution isn't really an aligned incentive. It's more of like all of the leverage is in that institution. They have to make sure that if the business fails, they have a path to return. When we looked at this, we had thought about just doing term loans, but they don't align incentives in a great way. And so what we did was we kind of built out, we call it the revenue sharing or revenue participation note, which is a debt instrument that's designed to allow a business to repay investors through a percentage of their gross revenue generated over a period of time up until a certain amount past the principal investment amount is hit. And so, when you invest in a company on Mainvest, as they generate revenue, you get a quarterly repayment up until your principal plus a return beyond that principal is hit over usually a 4 to 6 year timeline.
What does like an IRR or return percentage look like in a range? I know you can't guarantee anything.
When we look at it, we want to target somewhere between an 8 and 25% IRR for the asset class as a whole. And I think where it rests on that spectrum is a mix of analyzing risk and pricing based on risk, but also like understanding this new market when you're able to open up this asset class for investment to 92% of the population, 93%, depending on which study you look at, that previously was not able to access it. And when you have this open market that is able to come in and start investing in these businesses, and these are investors that 85% on average are within a 5-mile geographic radius of the business they're investing in. One of the unique things that happens there is you're moving the market validation phase for this business into their fundraising phase, like far earlier in the process. Whereas with like an institutional bank loan, you can collateralize, you'll get the money, you go, and then like, hey, do people actually want this? This allows kind of consumers to vote with their wallets, and it really democratizes the process to bring businesses that people want in the community. And so when a business raises $100,000 and it's from 90 to like 130 people in that community, that business is getting that market validation, as well as when they open their doors, having kind of an early adopter base that will service the business and is incentivized to, because, though that their total return is capped at a certain dollar amount, the faster and quicker that business grows and accelerates their revenue, the better IRR the investors actually get.
I'm going to chime in here on behalf of the listener who doesn't know what IRR is. Eric or Nick, can you explain what that metric means?
Sure. So IRR, it's a financial metric for basically evaluating like a rate of return in thinking through like an annualized, how much are you getting back for the amount of capital that you're putting in. And so, we tend to, in communicating, move away from IRR because it's challenging in the sense of, it's floating constantly because it's based on the revenue quarterly generated by the business. So, if a business hyper accelerates their revenue beyond their initial projections, that IRR spikes aggressively. It's kind of like a win more case for both. Like in a situation where investors are getting a higher return on an IRR framework than initially expected, it's because the business is crushing it. But what's also very exciting about that security is it helps businesses account for, like, in a point of seasonal downturn, rather than paying a fixed monthly rate, like they're paying back a smaller percentage of less revenue generated, which allows the business to kind of weather storms and stay afloat and still be like providing liquidity to their community of investors.
So if I'm the plan in Holyoke and I'm doing one of these fundraisers, what is the message to prospective investors about why they should invest and what they should expect to get as a return if they are not familiar with IRR or some of these metrics?
For sure. And that's where I think with the revenue sharing note, the way to think about it really is based on like the cap. And so for a business, they're like setting their securities. Remember, like we're not a lender. Like we're not actually setting the securities for the business. The business is able to structure kind of however they want and see if the market is willing to invest at whatever the price of that security is. But in communicating it to investors, I think the core thing we focus on is the cap. And so for a business that is raising $100,000 with a 1.5x cap, you're investing whatever your percentage of that $100,000 is, and say it's $1,000. Like you expect, if the business is successful, to receive a total of $1,500 for your investment. And the time in which it takes for that to happen is based on the performance of the business.
What's the average investment size?
Average investment, like median investment size, is around like 1,300 right now. It's gone up. I think it was like first 6 months or so, it was around 800. So it's growing. But I think it's important to think through it as it's not a bell curve. It's definitely a barbell, right? Where, if we look and try to generalize, which I would never generalize our investor base, but like if we were trying to kind of break them down, there's really, I think, two sides. And I jokingly call it like there's the Bank of America and the Bernie Sanders. And you have, people that are, they would donate if it was a Kickstarter. They're like really just like small cap amounts supporting the business, getting pleasantly surprised when they receive a return. And there's like a larger percentage of smaller cap investments there. And on the other side, I think really what kind of drives the large cap check size is like the financial analysis being done by investors that are looking at like primarily as an investment mechanism, and secondarily the feel good ability to actually invest in a local business, support that business, and also have some semblance of an ability to affect the outcome of that investment. When we hire a new employee and we buy them a MacBook Pro, like I'm not running to check the Apple ticker to see what I did. But when you have these small businesses, that the incremental value of a coffee shop having 100, 150 like community members invested that are buying one or two coffees a day from or even one or two coffees a month at that small scale of like what these businesses are doing, that's a massive, massive growth mechanism.
And so to repeat some of this back to make sure I'm understanding, when I invest into a company using the Mainvest platform, it's not like a Kickstarter or a WeFunder where I'm getting any type of rewards-based return. It's purely financial, and that's number one. Am I understanding that correctly?
I caveat it with businesses have the option to also have perks, but the primary reason for investing is a financial return. And also, you loop WeFunder in with Kickstarter. WeFunder actually is equity crowdfunding. So when you're investing in WeFunder, you're getting, not to give them a shout out, but you're getting security, not like a t-shirt.
And then second part of that question. So you have these people who you said at the one end of the barbell, who may invest in a Kickstarter if this company was using a Kickstarter. And then you have this other end of the barbell that is people doing financial analysis, seeing this as a real investment opportunity that's a good return on their money. That class of people, are they pulling out of some other investment bucket to use Mainvest as a platform? Like, what would they be doing if not for Mainvest?
So, I mean, that's a great question. As we continue to grow, very excited to start looking at understanding some more of the motivations there, and where is it something that it's a diversification play? We know that it is for some investors. There are investors that come on and are really using this to build out a portfolio of this asset class of revenue-backed securities on a local level. Some of them are investing in particular businesses, whether it's from a personal relationship with the business owner, and this is a way for them to do it where, without this regulatory framework, they might be well off and financially solvent by any traditional means, but the accredited investor regulations, they don't happen to have $1 million in net assets excluding their primary residence, right? Maybe they only have 700,000, but they should still be able to invest in a great local business they can support. That's where I think what's really unique about this in thinking about the structuring of these asset classes, and you take the small business market in the United States, this is, again, depends on which study you look at, but 50 to 60% of the US population is employed by or owners of small businesses. And it's just incredibly fragmented and scattered. And so creating this opportunity and bringing in all of these businesses into this platform where people can actually look at this previously inaccessible fragmented asset class and be able to, make investment decisions and scale and diversify into it is hugely compelling.
So your background with Uber was on the demand side, you said. How do you think about attacking a market from a demand side when there is this kind of barbell?
Honestly, like we really think of it more on the supply side, where the best way to drive increased demand is to have a large amount of high quality small businesses raising capital and having that like supply liquidity that creates options. That optionality is what like allows people to come in and say like, oh, maybe I wouldn't invest in a brewery, but suddenly there's a hair salon I'm interested in that, or like there's a yoga studio in Newburyport, Massachusetts. Like I'd love to invest in that. And so supply liquidity has really become the largest driver for demand liquidity, and the quality of supply, and the performance historically of the asset class, historically being about a year, being exactly what it says it is, has been really our biggest driver for growth.
And how do you think about the health of balancing that supply and demand?
So again, I think that bringing a business onto the platform, that business, it's not like they set it up and they walk away for 60 days. These businesses are going out to their community and raising the capital, and through that getting that market validation, getting that buy-in, and also getting the word out that they're coming. And when investors are coming in through that, they're getting their repayments facilitated through the platform. They're staying on the platform, and that's kind of what we've seen as the biggest growth drivers. Like people are coming in for a business, they're being introduced to the platform. They see more businesses come on that they want to support, and that drives reinvestment.
Now, a year since launching, what have you guys learned that is surprising and maybe counter to your assumptions? And what have you learned that completely confirmed your assumptions?
One of the things that we didn't really anticipate, I wish we could have said we did ahead of time, that has been fantastic, is the way that the liquidity is structured for these investors, where, when you invest in an equity, you're like looking at like maybe 6 to 8 years from now, that will provide a return. The quarterly repayments, bringing investors back to the platform, has been like this massive driver for us, where it's like, we were able to have literally put the money where your mouth is and show that you might be investing in good faith for your first time in a business, but as you see those returns come in, it like really legitimizes the platform. And I think that we came into it with a real, this idea was built off of a framework of economic development, and this idea of like what happens when you're able to take 92% of investable income that previously wasn't able to be brought into a community and open up that investment into these businesses with like a true market driven approach that has all of these like value synergies around moving market validation earlier in the funnel, creating a cohort of loyal people. It allows communities to actually take more control and build their communities themselves and feel that sense of literal ownership. And that core thesis, that was kind of what brought us there, and like seeing that like this is yes, we're a company, but like this is a vast amount of like socioeconomic value that can be created and unlocked. That thesis has been proven tenfold in the last 6 months, and we're feeling pretty good about it.
Are you seeing people who invest for the first time invest a second time?
Yes, and I think that's, again, in talking through like when you're looking at the supply versus demand and how to think about the growth of the marketplace. The best way for this marketplace to grow is for businesses to get successfully funded, and those businesses perform and provide returns in the way they said they were going to do it. What we see was early on, we had launched with like 4 or 5 businesses in October and had like maybe 7 by like January. What we saw, even with that like extremely limited amount of supply liquidity, was like a reinvestment rate of 8 or 9%, where people that invested in like the first cohort of businesses, as it were, around 8 or 9% of them reinvested in another business. And they might have been brought into that first business as like an uncle of one of the founders or, a friend in the community. But seeing as they got introduced to the marketplace and saw these other opportunities and reinvested in them, it was just hugely, kind of compelling and validating for us that, people come in for a business, but like then see what this is. And, it does provide value on both sides of the marketplace. There's a massive amount of socioeconomic impact that can be unlocked here. And I think they're sticking around. And I think since then, like the reinvestment rate, I think it's gone up to like 18, 19% the last time we pulled it, which was like a month and a half ago.
How many business opportunities have flowed through the Mainvest platform, and how many communities are you in right now?
So, I think like we've got 16 or 17 live right now. We've gotten 15 plus successfully funded. I think around 6 or 7 over the course of the year have not been successful. So I think we have around 85% success rate. And in terms of geographic communities, we're heavily focused on Massachusetts and slowly starting to kind of creep out into New Hampshire. We have an opportunity in New Hampshire that was successfully funded, a second one on right now. We had one in New Haven that successfully closed last week, one down in Rhode Island that we launched about a week and a half ago. And really just kind of experimenting with this idea of, as we continue to grow and scale, like knowing the importance of locality for this, like what are the levers that need to be pulled, and like how do we really figure out the most scalable and sustainable way to grow it organically, start to engage with different communities at different levels to bring more businesses in.
What's capacity look like for inbound? Like if someone was like, hey, I want to start this small business in Duluth, Minnesota, could you guys do that right now?
So we've gotten a lot of those, and we are staying reasonably regional right now. So, we've had to pass on a lot of great business opportunities, and we do our best to navigate them to other options, just because we don't want to like put something up in like Seattle without the ability to really support that business and put the breadth of our platform behind it as well. That's where in thinking through like the semi-regional aspect of it, I think we are live in New England is the way I like to say it.
What does onboarding or, getting a campaign live look like from your team? How long does that take, and how high touch is that?
It's definitely very different business to business. And, at this point, I think we've had a business that from first conversation had them live in 7 days. We've had businesses that we talked to in like October, November of last year that came to us like in July, and we're like, hey guys, like, we wanted to really figure this out, but now we're finally ready. So I would say it's incredibly varied, really dependent on, the entrepreneur and the stage in which they come to us versus their readiness to get going.
What is the biggest driver of being able to get going quickly? What does a team have to have ready to do or be able to do quickly to hit that like 7-day mark?
The most important thing is financial projections. And, we're not a lender, like we're not doing a traditional underwriting process in that sense, but I think we have a moral commitment to investors that like we're not going to put a business on the platform that we don't believe has like a clear path to success. Not that they're guaranteed to succeed, obviously, but I think one of the best drivers for identifying that is projections. And I use an example. There's a natural grocery store that had come to us a month ago that we had been kind of reviewing, and in looking at the projections, they're projecting a profit margin of around like 40%, which is 2 standard deviations away from the way most natural grocery stores would work. So that's something where, they were great entrepreneurs. We're likely going to, in the future, be able to bring them on the platform, but there's a step between now and then. And that's, again, going back to kind of having this all rooted in economic development. We've developed great relationships with, regional and municipal economic development agencies, with nonprofits focused on small business education and technical assistance, like E4All in Massachusetts, and the SBD, small business development centers that are regional across. And when we see these amazing entrepreneurs, and we're like, now we're not quite ready. You guys might not be quite ready. We have a bunch of great resources and sources to navigate them to empower them. And the happiest moment will be a few months from now when they come back to us and we're looking like, this is a great opportunity. We're excited to bring this on the platform. Let's get another natural grocery store in a market that doesn't have it.
How does that scale? How does reviewing businesses and essentially doing due diligence on their financial metrics and models, how does that scale?
It actually scales pretty well. In terms of talking through that financial projection model, it's a relatively quick process and can also be very easily productized when you can take all of these different like by category industry standards for the asset class, because breweries, yoga studios, like these categories have like traditional historic performance like metrics. And so being able to kind of plug in those projections against those and see how they fit, being able to plug in historical financials against the historical financials for the category really allows us to productize and scale the diligence process without risking lower quality investments.
How does reporting work on the back end? So they make the investment, it's very successful, and now there's quarterly reporting. Does that go through Mainvest, or is that?
So every quarter they upload their historical revenue for that quarter. The product basically pulls out the pro rata percentage that can be distributed to the various investors on the platform. and pulls it from the operational bank account directly through the ACH rails into the investors' bank accounts. And at the end of the year, we match up the reporting against the federal and state tax returns that the business provides as a fraud prevention metric.
What's the Mainvest model? If I'm raising money on the platform, how does Mainvest get paid?
We have a very aligned model for small business success. It was very intentional, where we have a one-time fee where we generate revenue, which is upon a business successfully closing their round. We take a 6% on average. I say on average, but 100% of the time it's been 6% revenue securement fee for the business successfully raising. So for a business that comes into the platform, that goes on, ends up not having the product market fit, not having the validation, not getting there, there's zero cost to them. And that's hugely important to us, because really the last thing we want is for someone to walk away from Mainvest $2,000, $5,000 behind where they were when they started.
So if you guys have this ongoing reporting that happens as the business closes annually, and I assume that would happen some number of years after a successful close, how do you guys think about the ongoing sort of maintenance to that account after you've kind of captured your fee? Or is that all automated and it doesn't matter?
A lot of it is heavily automated, but definitely doesn't not matter. And I think you view it as maintenance. We view it as this massive opportunity to like really be with these businesses through the extent of their life cycle, and being able to provide resources to businesses at different points. The learnings that we have from bringing this heavily fragmented market into one place and starting to see some of the opportunities around, when you have 40 local coffee shops that are all on the platform and able to kind of have like founder networking with these like different owners, have a support group, is immensely valuable. But there are some secondary things that come with the ability to like bring that class together around like collective buying power for different products across these different categories, to allow them to compete with institutional players on a macro level while still being local.
What is the opportunity or appetite for, as you guys as a platform grow and you see more of these businesses, you'll probably start to be able to create some of your own models of like what looks like a good investment at this 1.5 times cap. Does the Mainvest platform or team ever plan to invest in the companies themselves?
We do not. The general reason is regulatory. As an intermediary, like we can't, even if we wanted to, invest in the businesses. I think the opportunity there is really around, starting to down the line be able to work with a lot of the institutional profit organizations around creating funds to better distribute capital to small businesses at rates that make way more sense for those small businesses. And I think that's where, as we get more data and like to see like the continued performance of the asset class, like right now it's looking pretty good. Really, the most exciting challenge for us is this re-education around these stigmas of like 99% of restaurants fail. Like that's definitely not true right now, but that's kind of the way people think about it. And so again, being able to put the money in where your mouth is and put the stats behind it to kind of educate people on like how amazing this asset class is, not just from the actual financial opportunity, but for the impact that it has on kind of playing SimCity in these communities and having communities really have that aligned incentive around ownership. That's the model that we're most excited about.
All right. Well, this has been awesome, Nick. If people want to find out more about you, where should they go?
I mean, you can find out about Mainvest at www.mainvest.com. On that platform, if you're a business and you're interested in raising, please just schedule some time. Like we've got a bunch of great people that are they're here to help. And on the investor side, if you want to start evaluating this really unique new asset class of opportunities, see the past ones that have been successful, see what's currently out there. We're constantly adding great businesses, strong entrepreneurs, and I'd love for you to take a look.
Hey listener, have you ever wanted to get a message in front of the Upside audience but weren't sure how to sponsor this show or weren't able to do a long-term sponsorship? Well, now you can just go to upside.fm/classifieds and let our audience know anything that's going on in your world, whether it's an event, an application, a special coupon or deal, or just letting them know who you are, what your company does. All you have to do is go to upside.fm/classifieds and you can place an ad on this show. That's upside.fm/classifieds. All right, Eric, we just spoke with Nick Mathews of Mainvest. Where do you want to start today?
Let's start with the founder. I think he and his experience lay the foundation for the things I want to discuss later in the deal memo. So my first takes are that the Mainvest business model is predicated on the ability to roll out multiple cities across the country. Nick has potentially the best possible professional experience in doing that, being the lead of the sixth city to launch for Uber. I think he's incredibly smart and thoughtful in an industry that's regulated, which, again, I'm going to draw comparisons here to Uber. I think it's a very similar go-to-market business model that he probably learned a lot from as he heads into a more regulated industry of Mainvest. So overall, I think he's the right type of founder for this type of company. What were your thoughts?
That's interesting. His background is very rare and particular. I agree with that. And I think that can serve him very well. Theoretically, I'm interested to see if the Uber playbook of launching cities proves out to be a truly repeatable model for companies down the road. I think we've already seen that a lot of companies try to do that. And we talked to Summer Crenshaw in Cincinnati in our second version of the update. And she talked about how they're going city to city and that the Uber model was tough for them because it's a very capital intensive model to hire city launchers and then just sprout up teams of 5 or however many and put a bunch of money into marketing quickly and getting both sides of the marketplace. It worked, and it's worked for some other companies as well. I'm intellectually curious to see if that plays out to be a tried and true playbook that works for all businesses. We'll find out. But certainly has better experience than anyone else who doesn't have any experience doing that. Far better.
I think that, and I want to get your take on Nick as a founder in a second, but let's talk about the go-to-market strategy here quickly in the business model. If we're going to compare Uber and Mainvest, which I guess is something that this interview set us up to compare, Uber is similar to Mainvest in that the demand side of the market signs up once and then they can access it in any city that Uber is present. Same with Mainvest. They sign up once, they can access it in anywhere that Mainvest is present. The difference is that with Mainvest, you can sign up once and then at any time access any of those submarkets. Whereas with Uber, you physically need to be in one of those markets to access it.
Yeah. I think it's a different product entirely. I mean, Kickstarter didn't go city to city, neither did AngelList or anything like that. So I think it's totally different. His background that I think is even more relevant and interesting is what he kind of kept referring back to of, as I was exploring these different areas in Boston, I kept falling down these loopholes of economic development and what it looked like and getting frustrated by what was there and what wasn't supporting the businesses there. It's clear that he thought about this business for literal years before actually getting it off the ground. And I think that's a really good sign of him as a founder of being problem obsessed as opposed to solution obsessed or purely opportunistic. It's clear that he very much fell in love with this problem.
I would agree with that. I think it's a problem. I don't know how much of a problem it is. And that's probably a shadow I have in this space. So I did a little bit of research and I found that small business loans, according to the Small Business Administration, as of December 2015, so this is a little bit old data and I couldn't find the newer report, but small business loans totaled $436 billion. Of that, $131 billion are for less than $100,000 and $304 billion are for between $100,000 and $1 million. That means that the market size for Mainvest is gargantuan.
Very large. And what's interesting to me, I hear what you're saying. I feel like the market they're serving are the people who are not getting those. And what is the proxy for how many businesses are failing to get SBA loans or don't know how to apply to them or something like that? Because I think the opportunity here, there's definitely probably a lot of overlap. But having this as a new and different financing option just creates more access for people who, for whatever reason, can't or aren't accessing the SBA loans or small business banking loans.
I agree that it increases accessibility. I also think that it incentivizes owners differently, and I think that owners would prefer this over a $1 million bank loan on their books. So I think that the market is large, regardless of what percentage of individuals don't qualify for an SMB business loan. There is going to be a very large market for starting up these type of companies. And I think that when we look at the market opportunity, it goes into my third bucket of it's very, very, very big.
And I know their focus is on Main Street businesses, and that's what we're already saying is huge. To me, if this is a financial product they can offer to any entrepreneur, there are entrepreneurs in different categories I think would be interested in this. Even me as a bootstrapper, if I'm coming up on a tough quarter, a platform that lets me say, hey, I need some short-term cash. If you believe in me and my business, I'll pay you back at 1.5 times your investment. That's a pretty compelling product to me.
I think those already exist or are becoming to exist more and more. I don't know that mixing messages with Mainvest would be a strategically beneficial idea. I think things like what Clearbank's doing is trying to answer that, or what Shopify's doing, or what Stripe's doing to give you similar revenue-based financing alternatives for short-term cash are probably more geared towards the tech crowd. I like the inherent incentive alignment that happens with Mainvest by investing locally. It reminds me a lot of our conversation with Inkind and Johan. When you invest in something locally, you're more likely to go to it. I think that would hold up here as well. If I invested in a new barbershop in Cincinnati, chances I'm going to that barbershop, very high. So I don't know that adding those additional layers would be beneficial, and I don't know that that is their long-term goal at this point, although it might be.
Yeah, probably not. So to the local point, it makes sense that they want to start in one geography and grow out from there because you're building customers who are probably interested in other local businesses around them, as opposed to just opening up the platform for whomever. Maybe I'm getting a little bit ahead of myself here, but the measuredness to Mainvest growth seems in stark contrast to the Uber growth model that we saw before. It really seems like Nick is taking this intentionally slow and seeing, how these first few companies work out and what they learn from them before more aggressively expanding geographically. What do you think about that approach?
Have you read the newly released book on Uber?
You know I don't read.
Right. I haven't read it either. So I have no background into this other than some articles I've read online. But I believe that Uber started fairly small in the San Francisco Bay Area with a very small fleet of cars to test out their hypothesis. And that wasn't like a 2-week test. It was a while. And once they found product market fit with their black car service, that's when they started rolling it out everywhere. And then UberX came, and then it was grow faster and faster and faster. So I feel like this is that honing in stage where they're focusing on, all right, what does density look like of investors? Why does that matter? What does returns look like? How can we get a profile together of what a city could look like on Mainvest? And then we can think about other cities and towns and what fits and what doesn't.
It seems like one of the biggest advantages they have is that they've done everything to do the work to be aligned with regulation. It's this new financial product. And so that will naturally be a little bit of a moat for competitors. But if somebody else jumped through those hoops, it seems like you're back to sort of a land grab here, because if I'm a business that wants to raise on the platform, I'm going to raise on the one that already exists in my community. And so if someone sees what Mainvest is doing and they're on the other side of the country and they want to build up that market, I don't know, part of me, this is my 6 to 18 months is saying, okay, how quickly now can we get into other geographies?
I think conceptually, I love this idea. I think that anytime you have an alternative data source or an alternative way to invest in what was previously illiquid assets is going to open up some really interesting financial return profiles. So I think that you're going to see, if this expands and is national, you're going to see people create portfolios of these businesses and run essentially mini private equity funds, but for their own portfolio, investing $500 in a few different companies across the country that they're really excited about that diversify in a certain way. And I think that that's something that has not been accessible unless you are an accredited investor who happens to know a lot of business owners across the country, which how many people is that? Not many. That you could actually geographically diversify or specialize and create a services-based business in the geographies that you want to. So for me, it's like, this is a whole new, not asset class, but accessibility to an existing asset class at a scale that, if this vision plays out, is going to be akin to like what AngelList did with syndicate investing, except for the non-accredited investor. So what I want to see in the next 6 to 18 months are some metrics around how the current city is progressing. What does density look like? What have they learned? What are returns looking like? And I also have kind of a shadow that I'm going to throw in here at the end. Every time we have a recession in the United States, everyone always talks about how Main Street gets hit the hardest. Well, if we're sitting here on the back end of an inverted yield curve, and that has historically told us that a recession's coming in 6 to 18 months, how does Mainvest survive and thrive in an environment where the underlying assets of their portfolio and what the future success of their business looks like have historically gotten hit the hardest? It's a question I don't know if anyone has the answer to, and it's a question that might not even come to fruition. So just a macroeconomic shadow from me.
All right, guys, we'd love to hear what you think about this episode, what you think about Nick and Mainvest. As always, you can tweet at us at UpsideFM or email us hello@upside.fm. We'll be back here next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep